Let me be direct with you right now, and I mean right now, because every second you spend not understanding what just happened to gold is a second the people who engineered this collapse are using to buy back everything they forced you to. Sell at a discount. Gold hit all-time highs. A war broke out in the Middle East. Oil spiked past $110 a barrel. Every single model, every historical precedent, every rational framework built over 100 years of financial history said gold was going to explode upward. Instead, it got obliterated. 20% wiped out in weeks. The worst single-week decline since 1983 during an active war. That is not a market. That is not volatility. That is not bad luck. That is a coordinated operation, and the people running it are counting on you being too confused, too distracted, or too financially illiterate to see it for what it is. I am going to show you exactly what it is, who did it, and what you do about it. Before I go any further, if you are watching this channel and you are not subscribed, you are voluntarily leaving money on the table, and I have no sympathy for that. The analysis I am giving you right now is the kind of institutional-grade intelligence that hedge funds and sovereign wealth managers pay serious money to access. You are getting it here for free every time you skip the subscription button. You are choosing ignorance, and ignorance in this market is not a neutral position, it is an expensive one. Hit subscribe right now. It costs you nothing. Not subscribing costs you everything. Now let me take you to the crime scene, because that is exactly what this is. And I want you to look at it with the cold eyes of someone who has spent decades watching institutions manufacture exactly these kinds of moments. Gold was trading at all-time highs. We're talking north of $3,500 an ounce, a level that represented years of accumulated buying pressure, central bank demand, geopolitical anxiety, and genuine monetary debasement working its way through the system. Then a war breaks out. Not a skirmish, not a diplomatic incident, a direct military confrontation involving the United States and Israel against Iran. The Strait of Hormuz, one of the most critical oil choke points on the planet, is suddenly in play. Oil prices spike past $110 a barrel. Inflation expectations jump. Every model, every textbook, every Bloomberg terminal in every trading floor in the world is flashing the same signal: buy gold, buy gold, buy gold. Safe haven demand is supposed to flood into the metal. That is not an opinion. That is a century of documented market behavior. And instead, gold craters, 20% gone, the worst weekly decline since 1983. So either every financial model ever constructed is wrong, or something else happened. Something else happened. Here's what they did. And I want you to understand the mechanism, because the mechanism is the weapon. The CME Group, which is the company that operates the COMEX exchange where gold futures are traded, made what they called a routine procedural adjustment. They switched the method for calculating margin requirements the collateral traders must post to hold their positions from a fixed dollar amount to a percentage of contract value. That sounds like administrative housekeeping. It is not. It is a loaded gun pointed at every small trader and retail futures investor in the market. Because when gold is rising, as it was, a percentage-based margin means your collateral requirements rise automatically and continuously with every tick upward. It is a built-in accelerant for a crash. And then, as if that were not enough, they hiked margin requirements again. And then again, 3 margin hikes in less than 2 weeks. 3. The cascade that followed was not complicated, and it was not random. Traders who are long gold, many of them retail investors and smaller funds, could not meet the escalating margin calls. They were forced to sell. Their selling pushed prices lower. Lower prices triggered more margin calls. More margin calls triggered more forced selling. This is called a liquidation cascade, and it is as old as the futures markets themselves. The question you should be asking is not whether this happened. It did, but who decided it should. Happen right then, right at that moment, with a war raging and oil at $110. You ask that question and you follow the money, because the money never lies even when the people controlling it do. Following the money, in this situation, leads you to several places simultaneously, and each of them tells the same story from a different angle. Start with Turkey. Turkey's central bank, in the 2 weeks immediately following the outbreak of the Iran conflict, dumped somewhere between 60 and 120 tons of gold into the market. The largest weekly drop in Turkish gold reserves on record Why? Because the Turkish lira was under enormous pressure. Energy import costs went vertical when oil spiked, which meant Turkey needed dollars desperately to pay those bills. Gold was the most liquid asset they had, so they sold it. When a sovereign nation dumps 60 tons into the London gold market, that is not a ripple, that is a wrecking ball. Prices move globally, immediately, and violently. Gulf states were doing the same thing for slightly different reasons, liquidating gold reserves to fund war-related spending and defend their own currencies. These are not small players. These are nations with centuries of accumulated reserves, making emergency decisions under financial duress, and all of that selling landed in the market at exactly the same moment the margin hikes were forcing Western futures traders to sell as well. Coincidence is for people who cannot do math. And then there is the dollar itself, the DXY, the index that measures the dollar's strength against a basket of major currencies, surged approximately 6% right as the conflict escalated. Now, a stronger dollar makes gold more expensive for every person on Earth who does not earn dollars, which is the vast majority of the planet's population. So international demand for gold drops precisely when dollar-denominated selling is at its most intense. But why did the dollar surge? Because of safe haven flows. When the world gets dangerous, capital has historically run toward U.S. Treasury debt, which still carries the label of risk-free, regardless of whether that label reflects reality. War drives up oil prices, which drives up inflation expectations, which convinces markets the Federal Reserve will keep interest rates elevated, which means U.S. Treasuries pay higher yields, which attracts global capital, which strengthens the dollar, which crushes gold. That is not a market cycle. That is a feedback loop, and it operates like a machine. The machine, in this instance, produces one specific outcome. The United States government maintains dollar dominance while every other asset class and every smaller market participant absorbs the damage. I want you to sit with that for a moment. I want you to think about who benefits most from gold crashing at the exact moment a Middle Eastern war begins. And then I want you to stop being surprised when it happens again. Now, I'm going to explain the actual infrastructure that makes all of this possible, because without understanding COMEX, you will never understand the gold market. And I do not mean understand it academically. I mean understand it well enough to not get robbed. COMEX is the exchange where gold futures contracts are traded. Each contract represents 100 ounces of physical gold. But here is the number that should make every person watching this furious. Approximately 95% of COMEX gold contracts never result in any physical gold changing hands. 95%. These are paper bets on the direction of a price. They are financial instruments that reference gold without requiring gold to actually exist in deliverable form. The gold price you see on television, the one quoted on every financial website, the one your broker shows you, that price is primarily determined by trading in these paper contracts, not by the actual supply and demand for physical metal. It is a fictional price generated by a fictional market, and it has enormous real-world consequences for anyone who owns or is considering owning real gold. The registered COMEX inventory, meaning gold, actually available for immediate delivery from COMEX vaults, has fallen approximately 25%, even as this paper price crash has unfolded. Physical gold is being pulled out of the COMEX system. Buyers who can take delivery are taking delivery, which tells you that sophisticated market participants believe the physical metal is worth more than the paper price suggests. That divergence between the paper price and the physical reality is arguably the most important signal in the gold market right now, and the financial media is barely covering it, because covering it, honestly, would require explaining how the whole system works. And the whole system working depends on you not understanding it. Here is the final piece that should make your blood run cold. When the CME raises margin requirements 3 times in 2 weeks, it does not hurt JP Morgan, it does not hurt Goldman Sachs, it does not hurt HSBC. These institutions have balance sheets so large that a margin hike is a rounding error. It is noise. But a retail trader running a futures account or a smaller hedge fund with a concentrated gold position, a sudden tripling of collateral requirements is a financial execution. They cannot post the additional margin. They are forced to close their positions. They sell, and when they sell, the institutions with unlimited balance sheets, the ones who just watch 3 margin hikes, create a 20% price decline in their favor, step in and buy everything. Those smaller players were forced to liquidate at a discount. This is the oldest play in the book. Shake out the weak hands. Buy what they were forced to sell. Wait for the price to recover. Count the money. The CME described this publicly as a normal review of market volatility to ensure adequate collateral coverage. That is what they actually said. I want you to remember those words the next time gold mysteriously collapses during a geopolitical crisis. Now, I want to talk about France, because what France just did quietly and without much media attention is one of the most significant events in the global gold market in years, and most retail investors have absolutely no idea it happened. France is the fourth largest gold holder on earth. The Banque de France holds nearly 2,500 tons of gold. And between July of last year and January of this year, France removed every single ounce of gold it had stored at the Federal Reserve in New York. 129 tons gone. Moved out of the United States and replaced with newly purchased gold stored in Paris. Now, gold has been stored at the New York Fed by foreign nations since the 1920s. France's gold had been sitting there for over a century, and now it is gone. The official explanation from the Banque de France governor was that the gold held in New York was old, did not meet current standards, and that it was easier to purchase new compliant bullion in Europe than to refine and ship the existing bars. I want you to think about that explanation with a straight face. They are asking you to believe that 129 tons of gold with 999.9% purity in 12.5 kilogram bars, the exact specification that has been the global standard for the entire period this gold was stored, suddenly failed to meet current standards. Other European nations have repatriated gold from the United States at various points without needing this kind of workaround. Germany brought gold home. The Netherlands brought gold home, and neither required a conversion story. The logical interpretation, and I am not alone in holding this view, is that France requested delivery of its physical gold and the Federal Reserve could not provide it. So the United States offered to settle in cash, France accepted, and both parties agreed on a narrative about upgrading to current standards. Whether that is precisely what happened or not, what is inarguable is the result. France now holds 100% of its national gold in Paris, and France has concluded that Paris is a safer place to store national wealth than the Federal Reserve of the United States of America. Germany is next, and the Germans are not being quiet about it. Prominent German economists and former Bundesbank officials have gone on the record publicly arguing that storing gold in the United States has become risky given the current geopolitical environment. German lawmakers are openly debating repatriation. Germany holds approximately 3,350 tons of gold, and roughly a third of it is still sitting at the Federal Reserve. Now, I want you to think about a historical parallel, because the people who ignore history are the ones who get destroyed by it. In the 1960s, Charles de Gaulle, the French president, looked at the Bretton Woods system, which required the United States to redeem dollars for gold, and decided France should convert its dollar reserves into physical gold. The resulting outflow of gold from U.S. vaults was so severe that it contributed directly to Nixon's 1971 decision to end dollar convertibility to gold entirely. The event known as the Nixon shock, the dollar has been a fiat currency ever since. I am not predicting another Nixon shock. But when the fourth largest gold holder in the world silently evacuates its gold from American custody and gives you an explanation that does not hold up to 15 seconds of scrutiny, and the second largest gold holder is publicly debating doing the same thing, the appropriate response is not to change the channel. History does not repeat exactly, but it rhymes with enough precision to make a serious investor pay attention. Now let me tell you what China's doing while Western traders are being margin called into oblivion, because the contrast is instructive and the numbers are significant enough to change your understanding of where this market is going over the next several years. China's financial regulators recently authorized a program allowing 10 of the country's largest insurance companies, including PICC and China Life, institutions managing trillions of renminbi assets, to invest up to 1% of their total assets in gold. 1% sounds modest until you do the arithmetic. 1% of assets managed by these 10 companies alone represents approximately 200 billion renminbi, which translates to roughly $27 billion in potential gold purchases. $27 billion from one program involving 10 companies in a country where the broader insurance industry is still nowhere near fully allocated to this asset class, and where regulators have the clear capacity to expand this program to additional institutions if they choose to. Mid-tier insurers with higher risk appetites are already moving. The trajectory of this program is toward more capital flowing into gold, not less. Meanwhile, Chinese gold ETF inflows held firm or grew during March, the exact period when North American gold ETFs were experiencing significant outflows as Western investors were being forced or frightened out of their positions. The Shanghai Gold Exchange trading volumes picked up. The Chinese retail investor and the Chinese institutional investor moved in the same direction, toward more gold exposure, not less. And it is not just China. Central banks globally purchased over 1,000 tons of gold last year. Poland is buying, Kazakhstan is buying, Brazil is buying. These are not countries making emotional decisions. These are sovereign entities with professional reserve managers making calculated, long-term strategic allocations. And the reason is not complicated if you are willing to look at it directly. When the United States froze Russia's dollar reserves following the invasion of Ukraine, every central bank on earth received the same message simultaneously. Your dollar reserves are not yours if Washington decides they are not yours. That is not an anti-American statement. It is a factual description of what happened and a rational acknowledgement of the precedent it set. The logical response for any sovereign nation that is not a close U.S. ally is to hold more of its reserves in an asset that cannot be frozen, confiscated, or sanctioned. Physical gold held domestically is that asset. France understood it. The central banks of Poland and Kazakhstan and Brazil understand it. China understands it at a scale that is going to fundamentally reshape gold demand over the next decade. So here is the complete picture. And I want you to hold all of it in your mind at once. Western paper markets are being used to manufacture price crashes that shake out retail and small institutional investors. Physical gold is being pulled out of COMEX vaults and out of Federal Reserve custody by nations that no longer trust the system. Eastern institutional buyers are accumulating at a scale that dwarfs Western outflows. Central banks globally are buying at the fastest pace in modern history. And the official explanations for all of this: margin hikes are routine. France's gold was non-standard. This is all just normal market volatility. Also, transparently inadequate that accepting them requires a deliberate suspension of critical thinking. The paper price and the physical reality are diverging. That divergence does not last forever. When it resolves in favor of the physical market, because physical gold is the real thing and paper promises are not. I am going to close by giving you the only framework that matters in a market like this one, and then I'm going to challenge you to do something specific. The framework is this: watch what institutions do, never what they say. The CME says margin hikes are routine. Watch what happened to price immediately after 3 of them in 2 weeks. The Banque de France says their gold was non-standard. Watch the fact that they now hold 100% of their gold in Paris. Obis tells his billionaire clients that gold has an overwhelmingly positive medium to long-term outlook. And watch Chinese ETF inflows while Western ETFs bleed. Central banks globally are buying gold at a pace not seen in decades. Watch that, not the CNBC commentator telling you the gold trade is over. The paper market is a weapon aimed at people who do not understand it. The physical market is telling a completely different story. Your job, if you are serious about your financial survival, is to understand both. Know which one reflects reality and position yourself accordingly. That requires knowledge, not luck. It requires understanding how cycles work, how institutional positioning shifts, and how to read the signals that the financial media is either incapable of reading or incentivized not to share with you. That is what I teach. That is what every video on this channel is designed to give you. Now, here is your challenge. Share this video with one person in your life who still thinks the gold market is just a normal market responding to normal supply and demand. One person. Because the gap between what Wall Street knows and what retail investors are being told is not closing on its own. It closes one conversation at a time. And the conversation starts with you having the courage to say that something is wrong with the official story. Either you fight for your financial intelligence or you pay for your ignorance. Those are the only 2 options available. Choose.